It's the end of the quarter once again. Merry Christmas, and we're going to take a wander through the markets and see what's been happening and where we might go to from here. Obviously, nothing's a recommendation to buy or sell any financial instrument. This is just for education and entertainment only. Uh, Kicking off with a quote this time from John Maynard Keynes, the 20th century economist. One of his most famous insights wasn't about macroeconomics at all, but in fact about the markets, when he said that markets can stay irrational a lot longer than you and I can stay solvent. And that will become very relevant as we see heading into the US stock market, that we're once again a new month and another all-time high for this market. There's a lot of chit-chat around about saying this market must fall, this market is going to crash. But if you make that bet, you're going to be wrong way more times than you're going to be right. And so, while the market looks like it's irrational and it just wants to keep going up, then I guess we just have to favor that. On a technical basis there, you can see it's through that 6,000 level. It's a clean break now there. It's been up there about 2 or 3 months, in fact. And we would expect some sort of retracement back to that 6,000 level at some point. But the next target for this market, which is only about 114 points away from, is 7,000, would you believe? So I would certainly not be surprised if we saw that by the end of this year. Does that mean that this market's going to go up forever? Of course it doesn't. We will get a correction at some point. When that happens, nobody knows. If we zoom into the weekly chart there, you can see that clean break above after that retracement into the Liberation Day lows, and then back through that 6,100 level, and then way up there towards it's just about to touch 6,900 at the moment, and as I said, heading towards that 7,000 level. Chiku chart, we're looking at the Chiku span, that dark green line behind the price line, and the price itself both being above the cloud. That tells us the market's bullish. And should the market fall towards the cloud, we would expect demand to show up at the moment around about that 5,700 to 6,100 area. You can see it did exactly that back at that Liberation Day low, just kissed that the cloud on the bottom there before it took off again. So it's always all looking quite rosy on the price charts. The market seems to be very bullish, making all-time highs. The big question is it sustainable? So we'll have a look at the market internals. First one is the bullish percent index. So this is a market breadth indicator. And as you can see there, it's only showing about 58% of stocks bullish at the moment. So we're seeing a narrowing of participation. It speaks to the fact that most of the upside is being driven by a few of these larger growth stocks, the Magnificent Seven and so on. Those kinds of stocks are driving this market higher, and the rest, the 495 as they're called now, are just not doing nearly as well. So we're seeing some divergence there. We're seeing the market breadth making lower highs as the market continues to make higher highs. But that's just one piece of evidence, really. And it's not a really great timing tool, because these divergences can last months and months and months on end. You can see it's already been going for over a year, that divergence. So this doesn't necessarily mean the market's going to crash tomorrow. It's just a sign that the bull market itself is starting to get a bit long in the tooth, and you would expect to see that kind of divergence as a market becomes more mature. On the stocks above their 200-day moving average, it's a similar picture, but not quite as severe as you can see. We're seeing the highs starting to become lower each time they peak. But we've got a current measure of about 63% of stocks above their 200-day moving average. So that's reasonable. That's about 2/3 of stocks above their 200-day moving average, which is a reasonable number. It's not super healthy, but again, it wouldn't be an indication that you need to start shorting this market. It's just an indication that the participation is narrowing. Yes, Paul.
Line, please. What is the relevance of the blue line, please?
The blue line, well, it's actually misplaced. Thank you for pointing that out. It was actually supposed to be below that series of lows there, just to indicate where the indicator was coming back to. So yeah, just so it's hard. You can't really plot support and resistance on these charts because they're derivative, but yeah, it was just to sort of indicate that level there. The discretionary versus staples are often a leading indicator of the market. It speaks to the health of the market as well. If discretionary stocks are doing much better than staple stocks, that's a sign of a vibrant, advancing economy. And so that should generally help the market in the short term, at least. And as you can see, there's no divergence there. The indicator is making a higher high. The market's making higher highs. So nothing to see there. Same on the semiconductors. You would expect the semiconductors to be outpacing the S&P 500 because the stocks that are driving the S&P 500 are a lot of these big AI stocks. Meta, well, OpenAI is private; it's not on there. Anthropic's private, but Google's on there, Microsoft's on there. And they're all very hungry for semiconductors. They all want chips, 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 and they've got an insatiable appetite for chips at the moment to train these large language models that are coming out almost every month at the moment. And so that is driving the price of the semiconductor producer stocks up. And given that they are generally speculative, that again is another healthy sign for the market. I don't normally show this chart. This is new highs versus new lows on that indicator at the bottom there. It's really just to point out that the new highs on each daily bar are still outstripping the new lows. So again, that's a reasonably healthy sign for the market. As long as there's more stocks making new highs than new lows, that's going to continue to support the market. On the advanced decline line, you can see once again, this is also agreeing with the market. There's way more advancers than there are decliners, which kind of speaks to that last chart that we just saw as well. Again, it's agreeing with the market, so that should help the market to continue with the uptrend, at least in the short term. It's been a spectacular year for all three of the big indexes in the US. Nasdaq's up about 22% so far, the S&P up 17, and the Russell up about 16 there as well. That's about twice as good as you would expect for the long-term average. So it's obviously been a very stellar year. Would we be surprised if we saw some reversion towards the mean of the annual return next year or in the next following years? That certainly wouldn't surprise me. It can't keep on printing those kinds of returns year after year. It's just not sustainable. On the yield curve, well, this is in the so-called normal shape, which is low rates on the short end of the curve, higher rates on the longer end of the curve. Those shadow lines show where the yield curve has been, and you can see the red line is actually dropping at the short end of the curve there. We're obviously seeing the Fed's funds rate falling in the US. It was cut again this week, so their rates are falling. That's lowering that short end of the curve, and you can see from those shadow lines, even the longer end of the curve with the longer dated maturities is actually rising. So the curve is steepening. Now, generally, that's a good sign. That means that we're in a risk-on environment. There's very little to be gained by holding bonds, so that siphons money into the stock market and drives it higher. However, the context matters because whether the yield curve is normal now or not is depend. What it's telling us is it depends on where it's come from, and where it's come from is from an inversion, which was in place up until a few months ago. This chart here shows that pink area above the top. So this chart is charting the differential or the spread between the 10-year yield and the 3-month yield. So the very sort of short end of the yield curve, if you like. When the indicator is up in that pink area, that's indicating that the yield curve's in that inverted state. And the curious thing is that when the yield curve goes from inverted back to normal, that's often the precursor to a recession, which are those vertical gray bars. A little bit hard to see on this screen. So if this indicator is as predictive as it has been in the past, then that tells us that we're probably going to see some sort of recession. Otherwise, it's some massive false positive. That's the other scenario. But you can see it's just flirting with that zero line there. If it pops back down, then that's when we should start thinking about recession. The New York Fed actually tracks a lot of underlying indicators, and they give a recession probability within the next 12 months. It's actually been falling, as you can see there, and it's down about 27% now. But that's 27% in the next 12 months from now. We're actually living through when that curve was a lot higher in the 60 and 70%. So we're in the months that were forecast for when it was that high, which indicates that the recession actually might be closer than we actually think. But we'll see what happens next year. Onto the sentiment, and the put call ratio is very low at the moment. As you can see there, it's in that so-called bullish extreme. This indicator is inverse to the market itself. When it's very low, there's way more call options open in the market than there are put options. That generally means people are much more bullish. There's no demand for opening put options for portfolio insurance. So we get a very low indication now. When everybody's on one side of that trade, that's usually when we get a reversal in the market. So this means that the market is still very, very bullish at the moment, and there is always a risk of a sizable correction when we're down in that zone there. So we'll see if that plays out. However, it's usually tied in with the next indicator, which is the good old VIX, and you can see from this one that we're in a very sort of what I call the low risk environment, which is when the VIX is below about the low 20s. And this is exactly what you would expect in this type of market situation. The market's going up, everybody's piling into risk on assets. Nobody's willing to take out insurance because nobody thinks the market's going to collapse tomorrow. And so the demand for the stuff that the VIX is priced on falls, and the price of the VIX goes down. So that it just indicates we're in that very low risk environment, very risk on environment, and as long as it stays down at these levels, then we should expect the market to go higher. The CNN Fear and Greed Index, which is like an amalgamation of a lot of different indicators, all fed in to give a number between 1 and 100. It's actually been falling, which is very curious. We would normally expect as FOMO takes over and the market gets more and more bullish, that we should start moving towards that extreme greed on the right-hand side there, but that's not happening. And this actually is bullish for the market, because if people are fearful and liquidating their assets, there's going to be people coming in to take on that risk in their place. So you wouldn't generally be too worried about the state of the market until you see this indicator right over on the right-hand side pointing to extreme greed. On to the cycles now, and just a reminder that the 18-year real estate cycle, and if you were at the conference this year, you would have heard Phil Anderson, thank you, Paul. You would have heard Phil Anderson waxing lyrical about us coming into the peak of this cycle, which is due to peak next year sometime, 2026. So we all remember what happened in 2007, 2008. The real estate market started falling. It sort of had a snowball effect onto the stock market, and everything collapsed. So will we get something like that similar again this time? Who knows? It's probably unlikely, because every bear market has a completely different signature. So it's unlikely to look anything like 2008 this time. But it's not unlikely that we get some sort of crunch next year, and that feeds into the stock market, which would obviously have a negative impact on prices. Oh, sorry. Beg your pardon. Right. Okay. So that's the real estate cycle. Just want to keep on your radar. The annual seasonality. So we've got the actual what the market did this year, and we've got the cycle at the top there, and you can see it's not too far out actually. We got that sort of choppy January and February into a low. The cycle has us coming into a low in March. We hit the low in April, and then it took off. The one thing we didn't really get at all was the this thing's not going to work in the air, but that mid-year area there, where you would generally get what I call the northern summer doldrums, when all the traders in the US mainly go on holiday. July, August tends to be more sideways, but we didn't get that this year. The market just kept chugging along. It's actually starting to turn a little bit more sideways now, and the cycle has us coming into to highs at the end. Just a reminder, of course, in terms of seasonality, we're completing the most bullish time of the year, the last quarter, obviously coming into the so-called Santa Claus rally period right at the minute. And that also means that the next quarter will be, as we just saw from the annual cycle, it tends to be a little bit more choppy through that January, February, March period. So just be aware of that. Again, the market's come a long way in a very short space of time. So we shouldn't be too surprised if we see some pullback in the earlier part of next year. On the presidential cycle, we're in the post-election year. Hard to believe that the current incumbent's been there less than a year, but there we are. We've got another 3 years of this show to go, and you can see that once again, that the indicator kind of the cycle kind of worked for the first kind of half of the year. We got that kind of low into April and on the actual, but into sort of February, March on the cycle, and then we were looking for a peak in August. We didn't get that. We just kind of kept on going, and so we didn't get that pullback that the cycle indicates into November. So, but it's not too bad an analog. I'd probably give it a B plus as an indicator. And as you can see there, starting to move a little bit more sideways towards the end as the indicator indicates. So, of course, this being the post-election year, that means in the presidential cycle next year is what they call the midterm year, which is when they have the midterm elections in the US towards the end of the year, October, November. And you can see there it's much more choppy than what we've just been through so far. So we've got that classic January, February, March choppiness that we would expect anyway, and then we've got the cycles showing us a peak in towards April, and then that long road down towards the election time in September, October, reaching a bottom there, and then a rally. Usually at the back of the election, we get towards the end of the year. But you can see on the cycle, the chart pretty much ends where it started. And you can see this on a bigger scale here on the, if we just kind of string all 4 of the presidential cycle years together, and then the red line there is the current market. So you can see we've kind of followed the presidential election cycle through the election year, through the post-election year. And if we continue to follow it, you can see that it has us turning much more sideways, much more choppy environment, much more volatile environment as well. So we could be looking at the next year being a little bit more challenging than the easy money that we've seen come from the long side this year. And just on the decade cycle, so we're obviously coming towards the end of year 5, and interestingly, the year 6 also lines up with that same kind of scenario where we just have a really sort of an up and down choppy year, and there's nothing really much to write home about. Switching now to the Australian stock market, and on the monthly chart there, you can see we're flirting with that 9,000 level still. The market has moved quite swiftly higher towards that spike low that you can see there. That was that Liberation Day low, and then the market just reversed and went straight up. Tagged the 9,000 level, actually just moved a little bit through, as you can see here on the weekly chart, managed to just go up about to 9,100, but couldn't hold it. Had one go, had another go. Now it's pulled back a bit. It's around about 8,500 at the moment. But you know, this is not untypical of these kind of ASX 200 moves, and assuming that the market remains bullish. If I just go back to the monthly chart, you can have a look back and see periods where we've had 2 or 3 attempts to get through resistance levels before it's actually made it through. So I wouldn't be surprised to see the same thing this time. It's maybe just trying to gather a little bit of steam. There's actually just a hint of a support line just around about that 8,500 level where the market's actually found some demand coming in. So we could see it move back up towards that 9,000, especially if we get the Santa Claus rally coming back this year. Maybe we end on, you know, up near that area, and then start correcting next year. On the Ichimoku chart, the obviously definitely bullish, both the Chiku span and the price up above the cloud. And the cloud on these charts is projected out into the future. So if we do get that market coming down, we should expect around 8,000 to 8,200 to be the area where we see some demand coming back in. And just having it's a real mixed bag looking at the indexes in our region and around the world. The ASX 200s, the poor campaigner down there at the bottom, it's actually only made 4%, despite how bullish the chart looks. Obviously, that pullback that we've had in the last few weeks has fed into that loss a little bit. The Nifty, the Indian Nifty is the next, about 9%. We've seen the S&P already up about 17, but the two Asian nations are really the ones that have been chugging along nicely. The Hang Seng there leading the pack at 27, and the Nikkei bringing the rear up at 26%. So yeah, so that's where the action was this year, over in Asia, not down here. On to the currencies, and the US dollar is well, we spoke earlier about how the short end of the yield curve is dropping, and that's because the interest rates in the US are dropping, not least of which is the Fed's funds rate, so that's making the demand for the US dollar weak. And so we're seeing there just slipping below that 100 level. This is an index, remember, so it's index points, not units of currency on the y-axis there. But so it's slipped below. It looks like it's now just finding resistance again at that 100 level. So that would seem to suggest that we're now in that 90 to 100 area of chop there, as you can see on the chart. So a weaker US dollar, of course, helps all the other majors, not least of which is the Aussie dollar, which had actually gone down and tagged that 60-cent level, which has obviously been quite a stiff support level going back a few years. And that was enough to turn it around. The weakness in the US dollar is helping the Aussie dollar move up, and it looks like it wants to try and head for 70 cents up there at the moment. So looking a little bit bullish short term, despite the long term trend still being massively down. Obviously, the interest rates, the cash rate here is now higher than the Fed's funds rate, so that differential is helping our currency as well. On the euro, well, the euro is the euro and the USD are the two biggest traded currencies in the world. So anytime one goes one way, the other one goes the other way. So that weakening US dollar is massively assisting the euro to try and make a launch up there for that 125 level, which has been a key level going way back, almost to the inception in the 90s of the euro. So that would be significant if we saw the euro reach up towards that 125 area. The pound, unfortunately, is not seeing as much upside due to the weak dollar that we might expect, especially what we're seeing with the euro. So it's still 5 area. And the Japanese yen is also looking very weak at the moment as well. As you can see, it's moving. It bounced off that 0.0062. That's 0.0062 yen to the dollar. So a very small number. But that's actually a very long-term support level that goes way back to the 90s as well. It's bounced off that, but as you can see, it's not made much headway since then. It looks like it's heading back down there. If it broke through that support level at 0.0062, that would certainly be significant. And good old Bitcoin has had a bit of a turnaround since we last spoke, and it's now looking like that break through the 109,500 level is now starting to look like a false breakout, as you can see there, or a bull trap, you might want to call it. It managed to get up and tag 125,000, but it didn't manage to hold it, and it's gone pretty much in a straight line down since then. So there's no obvious line of support where it is. Probably 74 is going to be the next line in the sand should it get back that far. But yeah, I mean, we all know how volatile Bitcoin is, so this shouldn't be any surprise, despite the amount of tears that are being shed online about this thing. But yeah, it's obviously very volatile, and who knows, maybe this is a buying opportunity coming up. And wrapping up on the commodities, first to crude oil, of course, and continues to weaken. Of course, as technicians, we wouldn't have been surprised by that because we could see a massive descending triangle that took what's that, 1, 2, 3, 4, 5 years to form. So it wasn't too much of a surprise when it finally broke that level, that 64 level. It's now below that level, and it's kind of it did sort of bounce back up, but now it's we're trapped below it once again. So it looks like it's going to continue to weaken from there. And if it can't hold 55, then it would go lower from there. Copper has been in the news, of course, because it's doing very well, making all-time highs at the moment. Obviously, big input to the green tech revolution. So a lot of demand around for copper, and there are some supply constraints, not to mention tariffs, which are having a negative impact as well on the supply, and that's driving the price up. So I think copper is going to be a good long-term play, but whether you'd want to be getting involved at these levels, I don't know. But nevertheless, it's looking very bullish for copper. And on iron ore, well, very much sideways for iron ore. Nothing to write home about here. It's kind of wobbling around that 100 level there. As you can see, the last sort of big high we had was that 145, which is well, that's a couple of years ago now that we saw 145. Doesn't look like we're going to see anything like that anytime soon. But on a technical basis, it has sort of reclaimed that 100 level. So 100 remains the support level there for iron ore. And we can't wrap up without having a look at good old gold, because it just continues to amaze me that the chart looks like this. With a market the size of gold. This isn't just some tin pot cryptocurrency shitcoin. This is gold, and it's behaving very rationally at the moment. But believe it or not, it's not the pièce de résistance of this talk. Yes, because silver is the poster boy for bullish action this year, up 117% this year, and blasting through its old all-time highs of $50, up into 60, yeah, 63 on that chart. Yeah, so silver is where the action's been in the last few months, and you can just have a look at that stack of green candles there. Even if you'd bought it at the start of this year and done nothing, you'd be sitting very, very pretty at the moment. So just to wrap up, US stocks, obviously, we're at those all-time highs. We've obviously got the seasonal tailwinds, as I call them at the moment, which is the Santa Claus rally, the bullish seasonality of the last 3 months of the year. I would be very surprised if this market didn't continue up at least until Christmas. What it does next year is a little bit less clear to see. I mean, there's obviously an AI bubble going on at the moment. A lot of these companies are way over valued, and eventually the piper will have to be paid for that. So how long that takes, but nobody wants to leave while the party's still going. So we could see it drift into next year. There's always the January effect as well, which can tend to be quite bullish for markets as well. But if I was a betting man, I would say things may start to get choppy first quarter of next year. Then we've got the Aussie 200 looking at that 9,000 level, just sort of sputtering towards it. That would be significant if it managed to get up there and capture it. Depending on how the US markets play out next year, that's obviously going to feed into the local market. So it may not be able to hold that level. And on the currencies, we've got that weakening US dollar. That's helping all the other majors. And then we've got that Bitcoin waterfall that we're seeing at the moment as it dribbles down. And on the commodities, oil looking weak, copper looking bullish, and the precious metals are go, go, go. I'll just leave you with this. This is my dolphin strategy, which has actually had a very good year. It's up 25%, very low volatility of returns, not unhappy with that. More information at quantconsole.com. And if you want to get a hold of me, I'm very easy to find. helixtrader@clemstar.com if you want to drop me an email, or follow me on X or YouTube, Helix Trader. You'll find a recording of this up there by tonight. And with that, I'll thank you very much for your time. Wish you good luck, good trading, and all the best for next year. Thank you.